And good morning, everyone. John Hutchinson and Jeff Wood with Traders Reserve. Welcome to Breakfast Club this September the 8th, 2025. The NFL season is underway, so that's exciting for people who care. And big week on some inflation data. So we might see any kind of outcome. Markets up, markets down, markets flat. But we have a lot to cover today in a little bit of a different direction. So, fortunately, we are recording this and we'll try to work our way through in about 30 minutes as usual. Want to start up with some key updates. For those of you who are part of Three Stock Strategy, a reminder that today is entry day. Please check your email as the three stocks were emailed to you last night, along with a new capital management approach that Jeff has worked on, and I really like it. I think it's going to be, you'll find that it makes a lot of sense. Um, if you can still use your equal shares or your equal capital, either will work. But this new approach is very unique, and I think Jeff had to string together 32 quadratic equations to come up with this one. So, uh, there's a formula behind it, and there's a rationale, and we'll see with the first three stocks that we've put out how that plays out this month. The Google trade that we gave you last week on Wednesday, with the massive gap up move on Wednesday, and then sort of a blow off rally Thursday and Friday. That turned out to be a winner. We'll do a quick review on that laddered put spread in just a second. Uh, Starting to feel like we're back in the realm of bad data is good, um, where it implies rate cuts. As I don't know if Jeff, if you have a slide on this or not, but the expectations for a September rate cut went to 100% for a quarter point cut, and they are beginning to rise for a half point cut, which is not common for the Federal Reserve to have two separate instances of a half point cut within a 12-month period. Now, technically, it would be 13 months, but remember the last year, the first rate cut that the Fed put in play was a half point cut in September of last year. If they follow that up with another half point here, that would be, to my memory, that would be unprecedented in a financial crisis or credit crisis emergency, which we don't have. So uh, the other issue here is, and we're going to talk a little bit about this morning, was something that's a little bit different. Um, Economic growth indicators are stable. Uh, we're not necessarily back at we're not setting records, but the ISM services PMI last week was back to growth or expansion. The manufacturing is still in contraction, but it's holding at a level that it has been at for nearly 3 years. So that's not a great surprise to me because again, we're 60 to 65% services in the U.S. economy. So manufacturing hanging out around the 50 level is not necessarily the worst thing in the world. As well, the first prints of GDP were at or above estimates. So, on the growth side of things, it's stable, right? But growth follows labor. So, the weakness that we're beginning to see in the labor market um, could or would eventually impact the growth in the economy. But one of the questions that I'm beginning to ask for myself is whether or not there is an artificial reason for the labor market woes. Let me give you an example of what I mean by that in just a second. Sorry, I put these in the reverse order. So Google, last week we put on a three-tiered or three-rung laddered put spread, starting at the 210 level, working down to the 200 level. You can see on the far right-hand side, the hard right edge, as you know. This over here, we had the gap up move on Wednesday, and then Google just went straight up. All of our puts were basically from here down to here. So we, at a roughly $1.24 net across the three layers of vertical put spreads. So that's 2 weeks in a row that we've had a good idea. So the week before was Netflix. This week was this past week Google, and this Wednesday we'll see if we come up with something else on a Wednesday to Friday kind of trade that you can use to goose your income a little bit. So that's the Google trade. Let's get out of that one and get on with this one. So the thing, just to start thinking through. Uh, First of all, job additions for the year are still positive. They're not great, but they're not negative. June was revised to a negative number. July was revised slightly higher to a positive number. August only printed 22,000 jobs, but they were still positive jobs. Jobless claims. The weekly jobless claims are still at very low levels, printing an average of around 230,000 a week. That's well below the a past weekly moving average. That's the WMA of 250. And the market doesn't worry about jobless claims unless or until they are printing above 300,000 weekly for multiple weeks, right? That would imply severe contraction in the labor market. That's not happening. The unemployment rate, 4.3%, still below 4.5%. 4.5% is essentially the uh-oh level. That's when Wall Street begins to worry that you're getting unemployment creep. Um, but we're not there yet. I mean, we're moving toward it, but we're not there yet. The jolts have Now there has been a substantial reduction in the number of job openings over the last year. Uh, I want to say dating back to last late spring or last summer, uh, job openings were around the 10 million mark. So we have had a 30% reduction in job openings, but there are still 7 million job openings. And that's still a stable openings market. And continuing claims, while higher, uh, again, they have not breached the 2 million worry point, right? These are all of these little metrics in here. That's when Wall Street starts to say maybe something's going on. Now, is the labor market, strong and vibrant? No, it isn't. We're still in this idea or this landscape of no hire, no fire. So job additions are coming slower and slower and slower, but existing labor is largely stable, similar to growth. So the question that I started to ask myself was, why would companies not fire and not hire? What's the connector between the two? Across the landscape of growth and labor, obviously the number one target everybody points to is tariffs, but that's too simple. I know Occam's razor, right? Simplest explanation, yada yada, but that's too simple of an explanation for a complex economy. Um, and so one of the things that sent me down this rabbit hole was something that Jeff was talking about a few weeks ago during Breakfast Club, where he got that special invitation to crash a CEO party, um, or maybe it was a breakfast or a lunch or something. Um, and I'm beginning to believe that what we are seeing in the labor market is a transformation of business activity, and that transformation is the use and application of artificial intelligence across a wide spectrum of businesses, meaning companies are delaying hiring as they determine or attempt to determine where they can get efficiencies of scale using artificial intelligence in place of human labor, or uh, to enhance human labor, right? Um, Coding, software coding is a good and simple example. Artificial intelligence can speed coding development um, multifold, requiring fewer coders on staff because one person can do the work of two or three or four. Right? We're at that inflection point, which is no different than, or not very much different than, the assembly line, the development of the assembly line under Henry Ford, right? Instead of 50 people making a car, suddenly it became 10. The robotics changed that number from 10 to 5. I'm hyperbolizing and generalizing numbers just to make the point that as something transforms over time, it has an impact at the labor level, and that impact is at the labor level first. And I think that's where we are right now. We're at this transformational uh, point where businesses, including ours, are learning up as rapidly as they can how they can utilize artificial intelligence. Uh, to that point, last week I told you that there was a sort of a semi big announcement for Millionaires Trading Club coming up in October. And one of the things that Jeff and I have been working on quietly, silently in the background is something we call AI2, not 2.0, but AI2. And to explain this in a simple level, or at a simple level, those of you who have been with us for a long time have heard me drone on and on and on about foundation stocks, right? Those are stocks that create the foundation of a sector or an industry. Nvidia is a foundation stock, right? The chips that support uh, the AI, the use of AI in anything from computing to software, electronics, etc. Uh, the energy market is the foundation for powering the data centers that run very high requirements for AI computing. Those are foundation stocks. That's that example. But AI2 is that next level up. It is the adoption of artificial intelligence at the business level, not the consumer level, but the business level, that which creates economies or efficiencies of scale, competitive advantages, cost advantages, and ultimately profits and revenue advantages. This next generation of artificial intelligence is already underway. And what we've been working on, and we're still working on it, so we won't release this until October, is an index of stocks, which we call the AI2 Index. And to give you a little sneak peek at where we are right now, and we're still in the process of adding and subtracting stocks to this index before we release a final version of it, you could see a rather broad cross section in the market cap area here, right? So almost 50% right now are large cap stocks. Note here, only 13% are mega cap, but it's this section right down here, small, micro, and nano, right? These are your next generation of stocks. Companies that are just now popping onto Wall Street's radar, that are in this artificial intelligence space in a variety of ways. These companies you would expect to do well, right? They're known or well-known companies. In part, if you looked at the 13% that's mega cap, right? That would essentially be what I would call AI1, right? The laying the foundation, chip stocks, clearly foundation stocks. This movement to AI2, if you look at the sectors, it's the broadening out of how artificial intelligence can be used throughout a variety of sectors. And that's where it begins to create investing and trading opportunities for you. Uh, one thing that I will say is, unlike the pharmaceutical industry or biotech industry, right, where you're betting on a drug hitting the market, or the next big cancer drug, et cetera, um, AI is a little bit different because it's not it's very much different. It is not strictly geared toward consumerism. It will be at some point, but that next point, that next iteration would be AI3, right? AI2 is at that business level. And it's going to have, I know it's going to have significant um, impact on businesses across these variety of sectors. As you can see, some of these industries, the ones that I'm most targeting, or targeting the most, are software application and software infrastructure, because this is the adoption and the execution of artificial intelligence across these various sectors, right? So these companies right here in application and infrastructure are the ones selling to the companies in all of these sectors. That's the revenue growth for those types of companies. And we'll have examples for you in periods in the future. The other place, the other one here, aerospace and defense, especially with two things, two sort of compelling factor, excuse me. The Trump administration, as you probably have heard, is all in on artificial intelligence, making America the leader of AI. And they're also heavily invested in the growth of the defense industry. And those two things play well together, as evidenced by Palantir, which is, I think, still the top returning stock for the year. So this is just a primer. For those of you attending Millionaires Trading Club in October, we're going to be releasing the first version of the index. It will be a dynamic index, meaning I will regularly take stocks out, add new stocks in, and we're going to go beyond that index and uh, into the investing and trading realm, so that people have different ways to monetize those stocks that have the best potential growth long term, short term, this week. So whether it's options or stock trading, a variety of ways, without overwhelming, without making it complicated, but a variety of ways that each person can choose for themselves what's best for them. How something like this can fit into their trading or investing plan. So, with let me clear this for 1 second, so I'm not leaving it on the screen. So here's just a little bit of a little spoonful of honey as to what this looks like. So this is right now, we're at 138 stocks. That is not the final list. That's the first pass all stocks analysis. And my goal is to get this down to 100 by finding stocks. Some of the types of companies that I would take out of this index are what I call fake AI. They're companies that they've been around for maybe 5 or 10 years or 20 years, and they're just trying to position themselves as being artificial intelligence, but what their core business isn't really AI. So there's a separation here that needs to take place of essentially understanding each of the business behind each of these companies, and then are they a pure artificial intelligence? Are they artificial intelligence adjacent? Is artificial intelligence reliant upon them, like a chip stock or semiconductor stock, for example? Or are they just like trying to promote or market themselves as being in the artificial intelligence realm? And that's a company that I don't want in the index because it's not a legit play in my mind. But when we look at the performance here, and this is out of FinViz, and what I do is I can take a group of stocks and I can look at their performance versus the SPY, or the S&P 500 index, over any period of time. And if I look at it over the last 12 months, this column on the far right side, or the markers on the far right side, this is percent return. So from essentially 0 to 100% returns. Uh, these 138 stocks have hit that 100% return in the last 12 months. And they started the year at a 49% return here in the middle of the chart. So I lined out 2025, the start of the year. Those stocks had grown to 49%. They've added an additional 51% this year. That's 138 total stocks. Now you're not going to buy 138. Nobody is. Um, so if we just subtract out this performance from 2024, this index is up 51, almost 52% for the year. The SPY, which is the purple line down here, started the year at what would have been 6% growth from September to the end of the year last year, and is currently sitting at 11.2. So in either of these time frames, one full year or year to date, these 138 stocks are outperforming the SPY by 5 to 1. That's risk reward ratio that we want in our portfolios. Not our whole portfolio, but even a percentage or a segment of our portfolio, whether we're trading stocks, whether we're investing in stocks, whether we are trading options short term or medium term, like this week, next week, or this month, next month, etc. So all of this is coming to you very soon. So with that, let me turn it over to Jeff, and I'm sure you have lots of data for us to review for the week ahead. And The screen is all yours, my friend. Make sure you unmute.
All right. Thank you so much. Good morning, everybody. That is also very exciting stuff, and I'm just excited to be a part of that project. So it's a lot of heavy research and some formula creation and all sorts of good stuff. A lot of researching individual stock um, fundamentals, which is also fun to get into that since we do a lot of trading in MTC, but don't get into a lot of fundamentals. So it's been a fun project. All right, I'm just kind of stalling to get my Zoom controls so I can share my screen. And maybe, sure, is it this one? Let's try this one. All right, you should see a screen that says, okay, so where are we starting off the week? Pretty strong. Certainly seems so. This is taken just before we jumped on, and the S&P futures up, NASDAQ futures up, and Dow futures up. Now, of course, futures and overnight trading sometimes correlate to how the market opens and sometimes not so much. So just important to know that at least we're starting off strong, and we'll kind of see where the market goes from there. As far as the economic calendar goes, it's sort of a muted week. There's some important ones in there with core PPI and CPI. And certainly consumer sentiment always important, but compared to last week, this is definitely a muted week. The nice thing is that we have Monday and Tuesday sort of open to let the market do what it wants to do. Interesting here, or at least what was interesting to me, and John, you can chime in, is that the core or the CPI, which is the consumer price index year over year, is ticking higher. That's what everyone's kind of worried about, the whole inflation and everything. But if you look at core CPI month over month, and core CPI from the consumer prices, core excludes food and energy. Again, that's always funny to me because they exclude it because food and energy are the most volatile, except yet everybody needs food and energy. So I'm not sure why we exclude it. But anyway, so core CPI is essentially flat. It is ticking up higher, 0.3% month over month. So yes, goods are still getting more expensive month over month, but it's in line with forecast. In the PPI, which is the producer price index, that is actually showing a month over month decrease. Yes, it is still going up by 0.3%, but it's at least decreased from the previous month, which was a 0.9% increase. So if you look at the core data, producer price index is going up, but less than the previous month and going up, within expectations. The core consumer price index also very similar situation. So things have stabilized. There was, threats of tariffs. I'm not saying that tariff threat isn't there, doesn't exist, or that we couldn't be in a better situation, any of that sort of stuff. But what I am saying is that we seem to be falling in line with expectations, and the tick up seem to be these small incremental tick up rather than something larger. Now, it doesn't, sometimes some of this data takes 6 months to kind of filter through. So we'll still see. One of the things that I saw, speaking of fundamental data, is if you look at Dollar Tree and Dollar General?
Yep.
Yeah. Same quarter sales increased on both of those, and they increased in the markets of people who wouldn't normally shop at their stores. So I thought that was really interesting. That was called out by their executive team, is that they're getting people who don't normally shop at their stores getting a little bit more concerned about things, and so coming into those lower cost stores. So anyway, so all that's a little interesting, but the good news is right now everything, as far as the economic calendar goes, a little bit on the lighter side this week, and things should fall within expectations. But if you are trading those zero DTEs that I know everybody loves to do, you definitely need to make sure that you are watching out. All of this is pre-market, so or at least on Thursday and Wednesday pre-market, so it shouldn't impact anything too much unless you're trading futures. Then you definitely want to know about those times and those reports. All right. Some other big news coming out is the S&P 500 rebalancing. We didn't see any rebalancing in June, but it looks like if all things go the way as planned, it looks like Robinhood, AppLovin, and MCore Energy will all be part of the S&P 500 as of September 22nd. So nothing is guaranteed in trading. We know that, but index funds do need to acquire shares to balance out their portfolios. So what often happens is that prices continue to move higher after initially being added into the index because there's a flood of buying from the index funds. And then usually, if people don't know about that ahead of time, then they start saying, oh, we start seeing the retail news outlets talking about Robinhood, AppLovin, and MCore being added to the S&P 500. And then we get, fear of missing out, whatever. We get people rushing into those stocks as well. So just some important news. I'm not saying go out and buy all these things right now, but use your own discretion on and see if any of those fit within your portfolios.
Couple of quick notes while we're on this slide.
Sure.
It's one thing to note on Robinhood and DraftKings, if anybody follows DraftKings
Yeah.
stock. Robinhood is petitioning to join the betting markets, and DraftKings has received approval. It was either the CFTC or the CME, Chicago Merc Exchange, uh, to essentially provide wagering on movement in stock indexes. So
Oh, geez.
essentially, a bettor can say, "I think the market's going to be higher, whether it's going to be today or tomorrow. I don't know." But both DraftKings and FanDuel have both received preliminary approval to add index betting to their market. And Robinhood is working to get regulatory approval to move into the same markets. So that's number one. Number two, AppLovin, irony on AppLovin, that was a stock that I highlighted back in 2023 as one of my 10x stocks that I liked. And it did more than 10x, that's for sure. But they are in the mobile advertising, and they are one of the stocks that we are both AppLovin and Robinhood are stocks that we're considering as part of the AI² Index, as they leverage AI in a couple of different ways. AppLovin more so than Robinhood, because they are an mobile advertising platform. The secret to that, as it relates to artificial intelligence, is it changes mm, call it the process of creating ads. It accelerates the development of ads to be tested by businesses, marketers, etc., so that they can get uh, data back on which ads perform best. So that's a usage of artificial intelligence, which has legitimate business application in the ad, especially in the ad markets. And advertising is one of the biggest markets for artificial intelligence right now. Um, and MCore we've seen around before. I think we
Mm-hmm.
traded that in the three stock portfolio a year ago or a year
Mm-hmm.
and a half ago.
Yeah. Yeah. All exciting stuff. The unfortunate thing about AppLovin and digital ads is that means I'm gonna have to watch more ads when watching YouTube videos. But those things, yeah, we'll talk about that at MTC too. But it is amazing. There are now AI influencers that are completely AI generated, and yet they have more followers, and they're just cranking out AI content. Um, and they have more followers than human followers. It's crazy. It's a crazy business that we're in. But yeah, we'll talk about all of that in the upcoming October conference. All right, so seasonality, we talked about this a little bit. And since this is Breakfast Club, I thought we'd try to introduce some new concepts that maybe people aren't familiar with. So I've been talking about seasonality for a while now, but and we've talked about September historically being not a great month. It's actually 50-50, but when the down months tend to be bigger than the up months. But as far as trading up or down. It's about 50-50 over the last 15 years or so. Anyway, if you look at the data, uh, which I got from Tom's Option Tools, it's the first 2 weeks of September are usually the bad ones. So again, we're in that sort of month of caution, but it does start getting a lot better. Just you don't need to know all the numbers. Just know red, bad, yellow, getting better, green, good. So as far as, and we know that historically, October, November, December are good months. And so what this is really saying is that starts getting better mid-September, and definitely gets better at the end of September. So we're sort of in that first two cautious to bad weeks, and we actually haven't really had a bad September yet. So that's the good news in all of this. And if this holds true, if seasonality holds true, we have one more sort of week to get through, and then we'll start getting a little bit better. Next, market performance. We have been looking at the number of stocks trading above their 20-day moving average. The good news is the S&P 500 index at a good middle ground, 55%. That means that there's still plenty of room for it to move higher. Consumer discretionary, a little bit on the high side, 71%, although we normally talk about 80% or higher being that sort of caution period. So 71% still has some room to go. But again, if you're looking for momentum trading, you might want to be a little bit cautious in the consumer discretionary area. But overall, healthcare, information technology, materials, real estate, all looking pretty good, still has room to go higher. Communication services, which we're going to talk about in a second, very near that 80%, which doesn't necessarily mean an immediate reversal, but certainly one where you're probably going to be a little bit harder to get continued performance in some of those stocks. So just be a little bit careful about communication services. And utilities, deeply oversold at this point. Only 3% of the stocks trading above their 20-day moving average. Same thing on the reversal to the downside, or to the upside, I guess. Utilities being at 3% doesn't mean go in and rush in and spend all your money on utility stocks right now. But these, for those who are pullback traders, I would certainly be looking at utilities and trying to find the stocks that are heading for a reversal, because those stocks have definitely pulled back quite a deal. Now, as far as the last 5-day performance, again, we were in that cautious period. There are some great stocks, as John mentioned. Google is one of them, or Alphabet is definitely one of them. So there are definitely ways that you can continue to grow your account. But overall, the S&P market, S&P 500 market, in the last 5 days, showing lower by 0.3%. And energy, financials, industrials kind of taking that hit. So interesting about all this is, even though utilities and industrials took a hit by almost 1.5% or more, industrials and materials, they're not that bad as far as the number of stocks trading above their 20-day moving average. It just means that you have to go find those stocks that are moving in the right direction within those sectors. But what I wanted to show you is that this is using Heikin-Ashi candles just to help smooth out the trend. This is the equal weighted USA index, or the EUSA. That is still moving higher. Yes, we had a little bit of a pullback, at the start of the week, and we weren't sure if that was going to continue to go down. You never know if the red candles continue to be red, or but as of Thursday and Friday, we did flip over to a series of green candles. So there is definitely momentum hitting off of a trend line, and there is momentum moving higher. So we might see, if that continues, that means that there's a little bit more of a broad participation in a move higher, which is what we like to see. And if we dive into that a little bit more, what we're really seeing is the Midcaps. So this is the ticker symbol MDY for the S&P 500 Midcap 400 ETF. And again, we see this is the exact kind of chart that I like to see, lower left to upper right, just moving along. We did flip over again Thursday, Friday into a series of green Heikin-Ashi candles. So we are trading above some moving average lines, and again moving on to the green Heikin-Ashi candles, showing a strong trend to the upside. And then the Russell 2000, again, what we're seeing in the Russell 2000, now you never know, when you start seeing a pullback, if it's going to be something more, or if it's just going to pull back and then turn right back around. But really, since May, what the Russell 2000, this is the IWM ticker, what the Russell has done is it's had very normal pullbacks. Now, if you're in these, a 3.5 or 3.82% pullback doesn't feel very nice, but these are all pretty normal pullbacks. 3.82%, 3.42%, 2.27%. This one didn't even hit 5%. This is only a 4.87% pullback, which is all very normal in a bullish market. 2.4% in a 1.76% before moving higher. Again, Thursday, Friday switched over to green Heikin-Ashi candles. Doesn't mean that we can't flip over to red Heikin-Ashi candles, but those tend to stay green for a series of days. We're talking, I mean, this was 1, 2, 3, 4, 5, 6, 7, 8, 9 green ones, 1, 2, 3, 4, 5, 6, 7, 1, 2, 3, 4, 5, 6 green ones. So, we could see a bullish week based on Russell 2000, based on some of these other mid caps in the S&P 500. So that's all good. And I think what that's also showing us is a rotation away from some of the mega caps. I'm not saying this is going to last forever or last the next 3 months, but what we did see last week are, some of the big companies like Nvidia. Nvidia has been pulling back. We now see it trading underneath two key exponential moving averages. We see it flipping over to a series of red Heikin-Ashi candles. So I think what we're seeing, which is why there was a little bit of instability in the S&P 500 last week, is the S&P 500, of course, is a weighted index, and that weight is heavily on those mega cap stocks. You see Microsoft has pulled back. It's sort of flattening out around this 500-ish level, or slightly below now. But so what we're seeing, I think, is with the idea of rate cuts, I think we're seeing money flooding into some of these mid caps and lower, and getting away from the Mag 7. Again, I'm not saying all Mag 7s are bad, because as John mentioned, Google is one of those things that one of those companies that continues to move higher. Part of that is news driven. They are keeping Chrome in the family, so that helped. And they're having some other success with some lawsuits, although I think the EU just brought about a lawsuit to them, or charged them a couple $100 billion. But what's that for them? That's like one day of revenue for them. But if that continues, then so I think there are some stocks like Google that are sort of holding the fort down as far as the Mag 7 go. But I think we are seeing a little bit of rotation out of the Mag 7 into some of those mid-tier mid-cap stocks, and that is why the S&P is kind of faltering a little bit, even though if you find the right stocks within the right sectors, you're doing just fine. So I still hold by what I say. I still think this is a period of caution, but things are certainly looking up, and I think we could have a fantastic quarter ahead. But we'll see. And I think that's really it for me.
Okay, then we have Millionaires Trading Club at 11, right, Jeff?
Yes, yeah. I'm
And
on my own today, so we'll see that one.
well, have some fun with that. And then we should have Income Masters at 12:30. And Jeff and I will be back at 8:30 a.m. on Wednesday, September the 10th. So with that, I hope everyone has a great week. Be careful out there, and good luck in your trading. And we'll see you in a live trading session here a little bit later this morning.